behalf of the Tools for Life Learning Center at Loudon Habitat for Humanity, I would like to welcome you to today's virtual workshop on the fundamentals of financial well-being. My name is Amanda Bollig, and I'm the Program Project Specialist here at Loudon Habitat, and I oversee our home repair program as well as the Tools for Life Learning Center. So let's just get started with our goals for today. So we're going to first start with learning the definition of financial well-being. Then we're going to dive a little deeper and talk about those 5 key components of financial well-being. Joining us today as our speaker, Jim Wehr, a financial advisor from Veritas Financial. Hi, Jim.
Hello.
So Jim is a wonderful partner with Loudon Habitat for Humanity, and he has actually been a board member. So we are very grateful for all the work he's done for us and now helping us out here with the Tools for Life Learning Center. So thank you, Jim, for all of your hard work and for joining us today. We really appreciate it. If you have questions for Jim during the course of his presentation, go ahead and put those directly into the chat box, and then we'll answer them at the end of his presentation. All right, Jim, I'm going to go ahead and pass it off to you so you can get started with the presentation.
Very good. Thank you very much. So, good morning, everyone. As Amanda said, my name is Jim Wehr. I'm with Veritas Financial. We're going to be discussing an overview of financial wellness. We know the route to financial well-being will be different for everyone, but regardless of what path you take, a strong grasp of the fundamentals is imperative. If we go to our next slide, please. So here we have the standard disclaimer. We're gonna kind of blow right through this, but what I want you to understand is the information I'm about to give you is true as far as I know it, but you shouldn't really take this as actual advice. Fair enough. The lawyers are now happy, and we can go on to the next slide. So, what is financial well-being? To put everything we're going to talk about today into context, the Consumer Financial Protection Bureau defines it as having control over your day-to-day, month-to-month finances, having the capacity to absorb a financial shock, such as period of unemployment, for example, being on track to meet your financial goals, whatever those happen to be, and having the freedom or the financial freedom to make choices that allow one to enjoy their lives. So as we're going to go through today's financial wellness overview, we'll be talking about concepts and ideas that are going to touch upon each one of these 4 definitions. So let's do a quick overview of the primary topics we're going to be talking about. We're going to talk first about savings. Everyone needs to save. It's often the foundation of all of your financial strategies. Next, we're going to talk about investing. Many people may be apprehensive about investing, so we're going to discuss a few overarching concepts that will hopefully make it seem a little bit less daunting. Then we're going to discuss options for protecting what you've worked so hard to achieve. And after that, we'll talk about retirement planning in a very general terms and some ideas that you should probably consider. And finally, we're going to talk about estate planning. Now, you might think estate planning is only for the very wealthy. Not really. Estate planning can be used as a roadmap for how your assets, debts, any other tax liabilities are actually adjudicated after your death. So with that, let's go ahead and begin. We're going to start with saving. Saving is probably the most important element of all of this. It becomes the foundation for every strategy, every financial strategy that I've ever helped anyone design. Most of you know how to set a savings goal. You basically identify the cost. You figure out how many years it's going to be until you want to have that thing, and you divide it by the number of months that you have, and that until that time comes, and that essentially sets up the amount of money that you need to set aside on a monthly basis in order to get to your desired result. Right? That's what you're doing when you're creating a timeline. When you have these two things, a simple calculation, in fact, does it. It's a very tried and true way of meeting your savings goals. Unfortunately, though, life can often take some detours. It's not quite so cut and dried. Priorities change. Outside forces can derail even the best laid plans, or as some people like to say, life happens. So instead, maybe you should consider setting a savings goal as a percentage of your monthly take-home pay. One suggestion, and one that financial advisors often use, is to set aside 10% of your net monthly income. I would make the argument that if you set aside 15% of your net monthly income, it's almost impossible to fail if you can do that on a routine basis. But we'll use 10% for now for today's purposes. Include this savings amount as a fixed expense, as a line item in your budget. The concept here is to pay yourself first before anything else. Once you begin to save 10% of your income each month, you can then start divvying up or allocating where that savings amount is actually going to go based upon what your priorities are. For example, it's critical that everybody has an emergency fund. Financial advisors will tell you that this should be somewhere between 3 and 6 months of your net income. This is a buffer against unforeseen expenses. If you have a savings account or a buffer account for an emergency fund, you're less likely to have to throw the very next emergency on a credit card. So it helps keep you out of debt. All right. Once you reach the 3 to 6 month of income into your emergency fund, we can then start reallocating a portion of your 10% savings into other sorts of things. So, for example, we might next choose retirement savings, or we might choose setting aside some of our savings. Savings is all about balance, and balancing your saved monies with your priorities is critical. Next slide, please. So again, you want to make it part of your actual monthly budget. A line item. Make sure when it comes to savings, you consider the pay yourself first approach, which we talked about. It's simply a way to save, like using direct deposit, to ensure that money is set aside ahead of time. As they say, out of sight, out of mind. In this case, out of sight, out of burning a hole in your pocket. There's a number of different things that you can use to make this happen. Banks, financial institutions are very, very good at creating methodologies to take a little bit of money out of your paycheck every month and send it to a separate savings account, or take it from your checking account on a routine basis and park it into a separate savings account with the same institution. Those little tricks, those little things can be very, very helpful to help you do what you've decided that you want to do, which is save systematically. The second way that you can save is enhance your savings, is to take a look at your expenses. I've mentioned a monthly budget a couple of times. Your monthly budget is the best way for you to identify those expenses that you could eliminate or perhaps reduce. You could take, I'm not suggesting that you cut off cable TV, right? Or cut off the internet, but you may look at your expenses and say, I don't really need to subscribe to all of those subscription services because in the last several months, we only really used 2 of them. That's the kind of thing. A close examination of your budget can help you find leaks, wastes, and inefficiencies in your personal economy that you can then push into savings. There's a simple perspective to keep in mind. A budget is not a restriction on your spending, really. Instead, a budget helps you spend more on what you've decided you really want. Next slide. Thank you. Many of you may already be thinking, savings can wait. I got plenty of time. And you may be right. But when it comes to compound interest, having plenty of time can be your best friend. Now, most of you probably already understand the concept, or what they'll call the magic of compound interest. And it really is magic. Put simply, compound interest is the addition of interest, first to the principal amount of your savings, and then thereafter to the principal and the previous accumulated interest. In other words, you're getting interest on interest. To illustrate how time can impact compound interest, if you look at this slide, let's look at 2 different people. Person 1, represented here by the green line on the chart, he or she puts $10,000 into a compound interest bearing account. We're going to assume that it earns 5% annually and that they never add any other money to this account. Excuse me. By the time person 1 is 70 years old, that $10,000 would have grown to over $104,000. person two has decided that savings can wait. All right. So in order for person two to have a similar amount in their account at age 70, they'll need to save $125 each and every month for 30 years. And even with that, they're going to fall a bit short by that time. All right. Now, these two people will likely both end up with a similar amount of money at age 70. However, person one has put aside a total of $10,000. Person two, on the other hand, needs to set aside 4 times as much, or $45,000, to have the same end result. The bottom line is that the earlier you begin to save, the more money, and by extension, the more flexibility you're going to have to reach your savings goals. So before we move on, a quick word about debt. Debt can be a huge, huge limiting factor, but I want to talk about how it relates to actual savings. All right. Many of you probably feel the effects of debt. I know I have at times in my life, especially if, like many Americans, you have outside student loans to repay, as an example. Paying off your debt is critically important, especially high interest debt. But as I've said several times now, reaching your savings goal is a balance between competing priorities. And that your competing priorities is often more pronounced in regards to your debt. You may have heard some financial pundits say that you should focus all of your efforts first on paying off your debt and second on savings. What you may choose to do is entirely up to you. However, it might make more sense for you to strike a balance between your debt and your savings. Think of it this way. You can choose to be debt-free within a certain period of time, and at the end, potentially have no savings. Or you can take a little longer time to pay off that debt, and you will pay more interest. But in the end, you just might have a pretty good financial cushion available sooner in case of a financial emergency, which we talked about earlier, and later to build upon when you are done. Think back to the previous slide where we discussed the effects of compound interest. If you focus only on your debt and not your savings, how many years of compound interest could you be missing out on? Okay, let's talk in general terms about investing. All right. When we talk about investing, we're talking specifically about putting your money into financial instruments such as stocks, bonds, mutual funds. Also included in this discussion would be cash equivalents like CDs, money market accounts. We're not going to get into details on each type of investment today. However, just make sure everyone understands what we're really talking about. When I talk about stocks, or when someone talks about stocks, which are also called equities, what we're talking about is the purchase of a share in the ownership of a company. These stocks or shares are issued by companies to raise capital. You can purchase and sell these stocks at your discretion on the open market. When we talk about bonds, we're actually referring to a debt. Bonds are issued by municipalities, governments, corporations. When a bond is issued, the money an entity receives in return is a loan that must be repaid over time with interest. Bonds are debt obligations. When you purchase a bond, you're essentially becoming a lender to that entity. So if you buy a Loudoun County municipal bond, as an example, you are loaning money long-term to Loudoun County. When we discuss mutual funds, we're talking about investment portfolios that pool your money together with other investors to purchase a collection of stocks, bonds, or other securities. Mutual funds are typically managed by professional portfolio managers who make investment decisions based on stated goals of the fund. Mutual funds are ways for the very small investor who only has $50, $100 a month to set aside to get involved in the financial markets with a great deal of choice, right? Regardless of what investment vehicle you choose, it's important to know why you're investing. What are your goals? What are you trying to accomplish? To answer this question, start by thinking of what your savings goals are. If you think about it, the money you're going to be investing is most likely going to be the money you saved. So what are your savings for? Start there and then speak with a financial professional about your savings and investing goals to try to develop a plan that will help you achieve these goals. Second, and very important, you've got to understand your risk tolerance. There are many tools. There's some great tools online that'll help you better understand what risk tolerance is and what your own personal risk tolerance is. We're just going to discuss this a little bit more in a second. Next, you got to be realistic about your investing expectations, right? Listen, we've watched this market boom and boom and boom in the past several years. We've also watched it bust in the past 10 years. Goals and objectives are. You got to know that you're probably not going to see a turnaround in your investments right away when that happens. It may take months or years before you see significant growth. Lastly, you've got to consider your investments as a very, very long-term proposition. There are going to be market ups and downs. It's important you don't panic when things don't go your way. Something to keep in mind as an example, the S&P 500 annual returns on average from 1950 to 2017 were 8.92%. In that time, there were market downturns. But what's important to know is that the longer you have invested in the market, the more likely is you're going to actually get gains over the long term. Fair enough? Let's move on to the next slide. So, what I'm showing you here is asset allocation models. And there's a disclaimer that goes with this. And this is hypothetical. We're not suggesting any one of these models would be perfect for any particular person. But this all starts with a risk profile. A risk profile helps you determine the level of risk appropriate for any individual investor. If you aren't sure what risk level you'd be comfortable with, take a few of those online surveys that we talked about to try to measure your risk tolerance and to give you a general idea of which approach might be best for you, whether it's conservative, whether you're moderate, whether you're an aggressive investor. Also understand there are many factors that are going to probably determine your risk tolerance. For example, age is a factor. How long you have before you'll need to use money from your investments plays a big part. And how much or little risk in your portfolio might include. The second factor is risk capital, meaning the money that, if lost, will not adversely affect your financial well-being. In other words, you don't really want to invest money that you simply could not afford to lose. How much you know about investing may also be a factor in your risk tolerance. If you don't have solid knowledge about investing, it makes determining your risk versus reward very, very difficult. In that case, perhaps being more conservative in your investments would make some more sense. And finally, your own personal comfort level is going to play a big role in risk tolerance. Some people have an inclination to be risky or conservative in style. Some people are in between. You know yourself better than anyone. These risk tolerance questionnaires can help you determine where you fall. There are other considerations you need to make. Consider seeking advice if you need help. Asset allocation is the way your portfolio is divided among types of investments, your portfolio makeup, so to speak. Your risk tolerance is going to help you determine how much of your portfolio should be invested in equities, how much in bonds, and how much in cash or cash equivalents. The pie chart that you're seeing right here is a moderate portfolio. Let's take this a step further by having a mix of stocks, bonds, and cash equivalents. Whatever that mix may be, you have in essence created diversification in your investment portfolio. Simply put, being diversified means combining a variety of assets and seeking a reduction in risk to any one particular asset. This strategy often works because different classes or categories of investments may not move in the same direction at the same time. In fact, they typically do not. Historically, we know that bonds tend to go down when stocks tend to go up. A common path towards diversification is to reduce risk or volatility, so to not only invest in a variety of asset types, but also invest in different categories within a particular type of asset. This could include, for example, not only investing in different types of stocks, such as value stocks or income stocks, but also investing in different industries as well. So perhaps you want to invest in high tech, where you want to have investments in consumer goods, like something that Procter and Gamble would make, or perhaps financial services, when you might buy insurance company or bank stocks. An easy way to plan for this is to simply think of your dad. All right. Give you an example. If you use DAD as an acronym, DAD. So D, determine your risk comfort. A, allocate your investments accordingly. And D, diversify within your allocations. Other long-term investment options. There are other options. A couple that shouldn't be overlooked are real estate and 529 college savings plans. I happen to run a little another outside business where we help folks determine the best ways to pay for college. So 529 college savings plans are very, very topical, and we're fortunate in Virginia, frankly, that we have a couple of very, very good ones. But owning real estate, either as your primary home or for rental income as a long-term investment, in addition to potential tax advantages, in other words, your mortgage interest is deductible, your equity position will probably grow over time, meaning that when it's time to sell the property, perhaps, or downsize in retirement, this long-term investment can show gains. Sometimes they're big gains. These gains can help work to build your retirement nest egg. Real estate investments can also be used to generate future income. If you're renting right now, you understand exactly what I'm talking about. Your rent is an expense, but that expense is income to the property owner. So real estate investments can also be used to generate future income, right? So later in life might be especially important during retirement, when you need additional sources of income beyond Social Security and retirement account distributions. You know, not everybody has a pension or a retirement plan or a 401k. A lot of people rely on rental income as their retirement income. And there's nothing wrong with that as a strategy when it's properly designed. So we said we were going to talk about 529 plans. Well, another investment you might consider is a 529. It's an investment vehicle designed to help parents and families save for higher education costs. The laws have changed on this recently. You can now use it for all educational costs. It doesn't have to be just college anymore. The advantage of 529s is that they are tax favored. In other words, you can put money into a 529 plan and it grows without income tax, so long as you pull the money out and use it for an educational expense. Currently, all states and the District of Columbia offer a 529 savings plan. Generally speaking, the earnings in a 529 plan are not subject to tax, so long as you use them for qualified educational expenses. That includes tuition, fees, books, room, and board. You cannot deduct your contributions to a 529 off of your federal tax return. However, in Virginia, you can deduct the contributions up to $4,000 a year from your Virginia state return. So there are definite advantages to 529s. Having said that, there's no reason to be investing in a 529 plan if you haven't already started investing in some form of retirement plan, or if you haven't, again, started basic savings program first. All right. So next we're going to talk about protecting the assets that you've worked so hard to create. So we're going to talk about property and casualty insurance first, which is my particular, I should point out, it's one of my particular pet peeves. We've all seen on television the competing ads between Geico and Progressive and Liberty Mutual, all right? And we all think they're funny, and I think they're funny too. I kind of get a kick out of them all. What's problematic about this is they're all focused on nothing other than price. Is Geico cheaper than Progressive? Is Progressive cheaper than Liberty Life? Who knows? And at any given day or time, one could be cheaper than any other. My problem is that what these advertisements have done is commoditized your car and your homeowner's insurance. No one ever talks in those ads about getting the proper type of coverage. All they talk about is getting the cheapest type of coverage. And you can make huge mistakes by the most dangerous thing we probably do every single day is get into the automobile and drive. Whether we're driving to work or whether we're taking the kids to school or whether we're picking them up and taking them to some kind of practice afterwards, it's actually a very dangerous thing. We might think that the purpose of car insurance is to replace our car if it's in an accident. And that is, in fact, one of the purposes of car insurance, but it's not the major purpose. The major purpose of car insurance is to protect all of our assets if we end up being responsible for hurting someone else in a car accident. So if we get sued or if we put someone in the hospital and we become responsible for hospital bills because of our activity in a traffic accident, it's the liability portion of our car insurance that pays for that. On top of the car insurance, there frequently sits something called a liability umbrella. If you don't have one, you should examine looking at a liability umbrella. The advantage of liability umbrellas is, number one, they're very inexpensive relative to the car insurance. Number two, they are just what they say. They are an umbrella. They sit on top of our car insurance. They sit on top of our homeowner's insurance. They sit on top of our renter's insurance to protect us in large, broad terms. They're inexpensive because most claims for liability are relatively small. The problem is, if you have a large claim, a large loss, you will easily exceed, your liability might easily exceed the amount of liability insurance that you typically have on a car or a homeowner's policy, and kick in to pay you. And one of the things, unfortunately, we live in a very, very litigious society. People sue people for all kinds of things every single day. The beauty of a liability umbrella is not only does it pay to defend you, not only does it pay if you lose, it also pays your court costs to defend you. So the purpose of the liability umbrella is to basically protect all of your assets, is to keep all of those things free and clear from any court-ordered liability. Okay? Let's go to the next slide, please. We're going to talk about health insurance for a second. Health insurance is key and is really important to our major topic, which is financial well-being. If you don't have health insurance, it's very, very difficult to feel like to have emotional well-being, certainly financial well-being, because nothing can upset your financial apple cart any faster than having an uninsured health problem, right? Trip to the hospital example. So there's lots of ways to do this. Traditional medical insurance is broken down into what we call PPOs, which we know as preferred provider organizations. HMOs, health maintenance organizations, are very, very popular. Lately, high deductible health insurance plans have become very, very popular, and they're often coupled with health savings accounts. Think of health savings accounts as tiny little individually owned IRAs wherein you can put money to help you cover future medical expenses, like your deductibles. Life insurance is nothing other than a financial product that is designed to replace your future earnings potential in the events that you pass away. All right. It's often been said that there's only two reasons that people ever really should buy life insurance. Reason number one, you owe somebody money and they require that you buy life insurance. All right. Reason number two, you love somebody. Right. The fact that you might love your family is the primary reason that people typically buy life insurance. Life insurance is a large bucket of dollars that step in primarily income tax free to replace your loss of earnings at your death. Okay? And that's really all it is. There are two essential types. The first is term insurance. Term insurance covers you for a period of time, typically 5 years, 10 years, 20 years, sometimes 30. It is temporary in nature. So if we were going to equate this to home ownership, term insurance is like renting. The second type of insurance is permanent life insurance. Permanent life insurance takes several forms, but the one constant in all of it is that it never expires. So permanent life insurance is a life insurance product that you buy during your working years, and it continues all through retirement until the eventual date of your death. The one thing to understand is, and therefore permanent insurance typically has an equity involved, it has a cash value. However, it will be more expensive. We generally tell people to do a study to figure out how much they actually need, cover as much as you can with term insurance, and buy the permanent insurance secondarily. All right. Next, we'll look at disability insurance. This is probably the most under-considered product, but perhaps one of the most important. Disability insurance is designed to protect your income. You can imagine what would happen to your family if you died and they were to lose your income. The only worst thing I can think about is not dying and becoming sick and unable to work. Because in this case, not only can I no longer provide for my family, I can't even provide for myself. All right. Many employers provide disability insurance, typically up to 60% of their base salary. Supplements are available to cover the difference, but it's a discussion you should absolutely have with your spouse, with your partner, with a financial professional. We'll move on. So let's talk about retirement for a second. All I can tell you about this is that retirement, in my experience, is changing. It's unlikely to look like what it looked like when our grandparents or parents retired. So where will you live? It's a big consideration. How are you going to spend your time? How long will your retirement last? I'll tell you, that last question there, how long will your retirement last, is really misunderstood. These days, we are telling people in our practice to plan on at least a 30-year retirement. Normal retirement age, my father retired at age 62. Normal retirement age today is age 67. And we are telling people that, certainly with a married couple, you've got to plan on at least a 30-year retirement. Not meaning that you'll both live 30 years, but that the odds are overwhelming that one of you will live at least 30 years. If you don't plan on a 30-year retirement, the odds are high that you could actually run out of money. All right. There are different ways to calculate how much you need to retire. I'd suggest you a lot of great sites online. You can also consult a financial professional for this. Importantly, you want to try to develop a retirement budget, right? Now, obviously, this is a lot more important as you get into what I like to call the retirement red zone, which is like the 5 years prior to retirement. But you basically want to look at your expenses. And you can see by this chart, you're still going to have housing costs. Even if your house is paid off and you have no mortgage, you're going to have maintenance, you're going to have taxes, you're going to have insurance costs associated with housing. You're still going to need to get around. Healthcare may become a bigger piece of your budget in retirement than it is today. You're going to still have to buy food. And you know what? You might just want to have some entertainment. All right. So a budget in retirement is every bit as important as it is while you are working. You want to establish what your sources of retirement income are. I'm sorry, I moved on to the next slide. Social Security, retirement accounts. I'm talking about 401ks as an example, 403bs, pensions, annuities, your savings, other sources, potentially rental income. Basically, you want to look at a variety of sources, just as you want diversification when you're investing. We talked about that. It's best if you have a diversified stream of retirement income sources. You don't want to have all your eggs in one basket again. The next slide. So this is a 4-box strategy. And basically, what the 4 box strategy is saying is you want to you want to align your expenses with your income streams. For example, you want to determine what your necessary expenses are, right? Housing, food, healthcare, anything else that is a necessity to you. And you want to line those up with your predictable and guaranteed income sources like Social Security, pensions, income annuities. You want to have enough predictable, guaranteed income sources to cover your necessary expenses. The balance of your expenses, which are discretionary, such as travel, hobbies, or whatever else you might want to throw in there, you can plan on covering from your investments, stocks, bonds, etc. So this is why the pay yourself first stuff that we talked about very early is so important. Okay. And next, very quickly about estate planning. Why is it important? It is important because if you don't have an estate plan, you actually do. The government has one for you, and down at the courthouse here, there are very specific ways that your assets will be distributed at your death if you have not done the very basic steps, such as having a will. I'm not a lawyer, but I will tell you that having a simple will, if nothing else, is actually the very basis of every estate plan. So what's an estate plan? An estate plan is simply a strategy, including a will, sometimes including a trust, to ensure the smooth transfer of assets from yourself to the folks that you leave behind, that limits taxes and probate expenses. Common strategies for that: wills, trusts, gifting strategies, the life insurance that we talked about early on. And the thing about this is that the tax laws are continually changing. So what might make sense today might not make sense 5 or 10 years from now. You need to keep this updated. And so in review, basically there's a lot of long-term factors that go into determining your financial well-being: savings, investing, protecting that money, thinking about retirement, and then at the end, creating some estate plan. All we're suggesting is that you think about these things in a logical order, and it all starts with the hardest part, folks, which is making out that first budget. And that's all I've got to say. Do we have any questions?
That was great, Jim. If anybody has any questions, we maybe have a couple of minutes to answer those. You can go ahead and put them in the chat box now. Then I will read them off to Jim. While we're waiting to see if any questions come in, I have a question for you, Jim.
Sure.
I was wondering if you could tell me if there are any risks involved if I move my savings into a high yield money market account.
All right. So money market accounts, this is actually a bit of a change in the laws. Money market accounts are now guaranteed. So you've got some guarantees up to, I believe the number currently is $250,000. So a money market account is liquid and typically has the same level of guarantees as a bank savings account would. They do, however, have higher minimums. So typically you're not in a position to move into a money market account until you have got some significant savings established.
That makes sense. All right, we did have a question that just came into the chat box for you. And it says, are you able to switch that 529 plan that you were talking about for the students and their education? Are you able to move it from state to state?
Yes, you can. It's called a 529 rollover. And there are a lot of good reasons to do this. We see this quite a bit. So a lot of people are putting their money into a 529 plan in a state that they don't live in, which has no real advantage because they're not able to get the income tax deduction off their state return. So you're able to roll, if you had bought the Minnesota plan, for example, and you now live in Virginia, you're able to roll that plan over to one of the two Virginia plans and now and actually get a state tax deduction for doing that. So yes, you can move them from plan to plan. The key here is just like your 401k, you cannot touch the money. It has to go from account to account.
Good. And then the last question we had is asking if the presentation will be shared. And yes, it will be. We have recorded this presentation and it will go up on our website next week. So anybody who wants to go back and take some more notes and listen to more of what Jim said, you can watch the recorded version on our website and it'll go up on YouTube as well next week. And I think that just about wraps everything up for us. So thank you all for your questions and for participating with us today. And thank you, Jim, for all of that wonderful information. That was a lot to take in. I know a lot of us will probably go back and rewatch and take down some more notes. So thank you. If any of you would like to join us again for another workshop, we have one coming up on March 18th. This will be at 6 p.m. and we are going to have Lisa from the Organizing Mentors join us, and she will be talking about spring cleaning for your garage. So you can sign up for that. Yeah, that's a great one. I'm excited for her presentation. So you can sign up at loudounhabitat.org/toolsforlife, and hopefully we will see you all then. Thank you for joining us.
Very good. Thank you, Amanda.
Bye, Jim.
Bye now.